And we are live. Welcome, Fearless, to another Tactical Tuesday. One that we've been looking forward to for a little while here. We've got a special guest with us today that's going to be talking to us about when we as parents become the bank. Now, the reality is that a lot of us know we're going to have to help our kids out. But what I really like about what Dion has to share with us today is that there's better ways to do it than just handing them cash or refinancing and having it affect our lifestyle and all these things. So, um, welcome, Dion from Kanga Mortgages. Super happy to have you here.
Yeah, happy to be here. Thank you very much, Tiffany.
Yeah. I like how in the intro you told me that you were originally from Australia and that's where Kanga came from because I immediately wondered, Kanga, like kangaroo?
That's right.
Yeah.
Yes. Yeah, when it was coming time to choose the name for my company, I figured, well, what do people remember? Well, they remember animals. And what might be unique? As much as it's confusing, yes, a kangaroo in Canada, but that's what I decided. We went with Kanga Mortgage. Yeah.
Too because then the accent makes sense, right? So it's like,
Yeah,
oh yeah,
otherwise.
okay. But
Yeah.
also accents are memorable too, I find. So yeah. Anyways, welcome. All right, guys. Who do we have here with us tonight? So, Dion is a mortgage broker, and so lots of times we have lots of mortgage brokers. We know we have fantastic ones that we recommend for you, but lots of times they have a specific area that they're in. Really interestingly, Dion, give us a rundown quickly again. What areas do you service in Canada?
Yeah, so we help people in Ontario, in British Columbia, and in Alberta for the most part. And we also help people in the Maritimes. Quebec is an area that we can't help in. It's a very special place. But pretty
Yeah.
much most of Canada is where we can help you, yes.
I love how you say it's a very special place. That's a very nice way of putting it. When we tried to go into Quebec, it was really the language thing definitely made it. So I like the wording special. All right, now let me just see. We've got, let's see, Lucho Salgado. Hey, hey, nice to see you. Tyson, I know Tyson is in BC, and Tyson actually has had, this question brought up a couple of times, so I think he's going to be particularly interested in this. So, okay, so hi, everybody else that's here with us. Not sure your regions, but um, okay, so let's start with the fact that reality is in Canada. Most of us are going to have to help our kids out, or our kids will be lifetime renters, which is okay too. But for those of us that are in the real estate investment community, many of us would love to see our kids get into home ownership.
Of course, yes.
So yeah, so you've got some experience. You've got thousands of families that you've helped do this.
Yeah, well, I mean, in my time working in finance and real estate, we've probably transacted about 3,000 mortgages. The majority of them are actually for what you would call your standard mom and dad property investor. That has been the core of our business. So my background is I used to be a financial planner and a real estate agent. I'm currently a humble mortgage broker, but I bring to this position that experience where we're helping people build portfolios. And now we're helping those same people, Tiffany, realize that, yes, their wealth, while they intended to leave it for their children, they actually need to access some of that wealth now in order to help their children now. Yeah.
Yeah, and I think that it's such an important topic because in my own planning, when I look at, how am I going to do it? Well, taxes are a massive consideration. So for me anyways, it's like, well, then I want to do something sooner rather than later, but then you do it sooner and well, now your future, your lifestyle, the things you had planned also change. So really looking forward to kind of talking about how this like wealth across generations. So tell me about, so this is your term that you like to help Canadians to create this wealth across generations. What do you mean by that?
Yeah, so many of your listeners have probably been the people who went against the grain. That is, they actually went and bought real property with their own two hands. They might manage the property themselves or they might have a manager, but they were the ones brave enough to actually go and buy investment property rather than just a REIT or just invest in the stock market. And you guys did that because you probably came to a good understanding of the power of leverage, of the 4-to-1 leverage that a bank will give you, meaning that your upside In a bad year is probably 25%. And in a good year, some of you experience 100% return on your cash investments. And that was for a better future. And now many people like you and me, Tiffany, may have arrived at that better future. And then it's like, okay, well, that better future was for us, but part of that better future was also because we wanted our children to have the best, or do the best they could with what they have as well. And while we were lucky enough to be purchasing property in a window of time where interest rates were at an all-time low and property prices was reasonable and cash flow was widely available, I think
Yeah.
all of us can understand that has since changed. And so what we need to understand is that, and I kind of put it this way, it's kind of like we won the lottery because we were in
Yes,
the
I
right
love this
place. Yeah.
analogy. I heard you say it. So
Right.
why did we win the lottery? And I totally agree.
Yeah. We won the lottery because, and I'll give myself as an example, as a case study here.
Mhm.
I purchased my first property in my early 30s in an outer suburb of Ontario of the GTA. I paid $315,000 for that property, and we managed to do that with an $80,000 income at that time. Okay. Now you go back to that exact same property, and that property is now worth around 900K. And the income required to buy that property is now closer to $200,000 rather than the $80,000 that we needed back then. And
Same
so
house.
you've got it, right? And
Yeah.
everybody listening to this who happened to buy property more than 10 years ago can fully relate to what I'm saying right now. And at the same time, you can see that your children, while the property price tripled, your children's income did not. That 30-year-old young couple today may not be making 80 grand, but they might be making 120, but it's still not enough to quite get there for that same property. And so we're facing this situation in Canada and in many sort of Western countries right now, Australia included, where the younger generation may not live as good a life from a financial perspective as their parents. Okay.
Yeah.
And so
Interesting.
it's like it's coming to that realization and figuring out how can we help them?
Yeah. And I think that I loved your perspective on the winning a lottery bit because so I've heard you say when if we win the lottery, what's the first thing that we would want to do with that money? And
Most people would say I'd help my family. And I don't know if I can see the chat, Tiffany, but I love asking this question, which is if you won 500 grand, how much would you give to your children? Are we able to see
Ooh,
people in the chat? I don't
yeah,
know if we can.
I can see them. It
Okay.
doesn't look like it's coming into here, but I can definitely bring it over to you. So guys, and there's about a 22-second delay in comments. So if you won the lottery, let's say you won 500 grand, how much of that would you give away? How much of that would you want to be giving to your kids? And that's such a great question. I love it. Um,
I
yeah.
can predict what people are going to say. They're
Okay,
probably
what are they
they're
gonna
probably going to say something like 10 or 20%, which
say?
is, probably around that 50 to 100K mark, which is generous. In my opinion, it's generous. Some of those who are maybe already set up financially themselves may give it all away, but I wouldn't expect that of most people, right?
Yeah,
Um,
probably not. So,
because
okay, so some of the answers. So Michael Beckershoff says 300K.
true, okay,
Uh,
okay.
Ivana says half.
Half,
Man,
okay,
we
great.
got some generous,
You got some
fearless
generous
investors,
people. Yes, yeah.
don't we? Fritz says down payment for their first home when they can qualify. I love that,
Mhm.
Fritz. Yeah. Helen, 400K. Man,
That's a lot.
yeah,
Okay.
like 80%. I
All
have a
right. So
big
what that
family,
tells me.
Janie says. So 5%. Janie says.
Okay.
Depends on, yeah.
Good, good. So what that tells
Good
me,
question.
Tiffany, is that your audience are above average in that they're abundance mindset, they're willing to give. And I'm guessing that they're willing to give because maybe together with you, they've built a portfolio which they can depend on already, right? And so they don't need this extra 500K. It's nice, but it's not essential for their long-term happiness. Okay. But yeah, but there may be others who actually would utilize that 500K because they still have a debt on their principal residence or because they haven't padded their RSPs or whatever it might be to the extent that they wish they could have. But it's an interesting perspective because many of you listening today probably say bought your house for say, let's say 300 grand. It's worth $1 million today. Or in fact, many of you thought it's maybe it's worth 1.5 million. I know many of you in Ontario are in that position. And never in your wildest dreams did you think that this property that you bought for 300 grand would be worth 1.5. You're probably sitting on $500,000 of equity that you never thought you would ever be sitting on. And that's the
Yeah.
perspective that I want you to take into what we're talking about today. Because while you are the winner of the lottery, you're the beneficiary of the lottery, your children are on the other side of the equation and they're the victim. And it's really the case that you need to rebalance this because you were lucky at the right place at the right time. Property prices went crazy, interest rates were low, cash flow was available. And now the tables have very much turned, and your children don't have the same playing field, and they don't even have the same rules to play on the playing field that you did back then.
Yeah, it's interesting. And I'm one of those people that I'm like, I'm not going to give you a fish. I'm going to teach you to fish. And so that's how I have always, parented. And now though, now I feel like, well, that's not really fair anymore because I was kind of given a fish. And so, yes, I was in the right. Yes, I took action. Yes, I did all those kinds of things. But still, a lot of influences went in my favor that are not necessarily going to. So I love all the analogy. I'm sure everyone who's watching too, saying the same thing. Like, yeah, okay, so we're in a different place than our kids were. We don't want to just give them everything at our detriment, especially. So I have a friend, for example, she's got some equity in her home. She has a son. She's like, Kate, I want to help him to, get started. I want to gift him this money. She's going to have to pull equity out of her house, refinance, pay more interest on that to do it. Her, lifestyle cash flow wise goes down in order to help. So she says, well, maybe I'll just save up, like buy a house for him, rent it out for the next little bit. When I die, he can have that house. It'll be paid off and, that'll help him out, but it'll help him out later. But then there's taxes. So like there's all these strategies. So what I really thought was interesting about what you bring to us here is you've got some different strategies. Now, let me see. You say that there's other things to do other than just giving our kids cash. You said co-signing, equity extraction, family investment structures. What are these things?
Okay, well, let's start with co-signing. Many of you might be familiar with this, but some of you aren't quite familiar with the technicalities. So co-signing is, let's call your son Sam. Sam is buying a property. He can qualify for a property of 500,000, but in order to buy the property he really wants to live in, it's going to cost 600,000. But Sam can't qualify. He's a little bit short by 100 grand. So the simple thing there that could be done is that mom and or dad could co-sign. By co-signing, what you're doing is you're adding your entire profile to his mortgage application. It means you add your income, but you also bring your debts, including your mortgage, to the application. And many people think that, oh, because they have a mortgage, they will not be able to help their child. Okay. But I'll give you a quick example. And many of you may already know this sort of rule of thumb when it comes to lending. We can usually borrow 5 times income. Okay. So if you come to me and you make $100,000, for the most part, you'll get around 500 grand borrowing capacity. Okay. It's plus or
Okay.
minus, but it's an easy rule of thumb. So
Nice.
if you come to me and you're the parent of Sam and you say, Dion, I'm sorry, I don't think I can help him because I already have a mortgage on my house. My first question is, what's your income and what is your mortgage balance? Okay. Because if you make 100 grand, I know that you qualify for 500K. But if your mortgage is only 200K, you have 300 capacity, extra capacity with which you could help Sam qualify for that property.
Well, I have qualified on the mortgage at that $500,000 mark 15 years ago, let's say.
Sorry, could you say that again? I missed the start.
So, so the 300,000 that's, equity in there, I
Extra.
still qualified at the $500,000 mark though. So that's not counted against me, that extra.
Yeah, so let's say that you're the mother of this child. You would qualify based on your income, you qualify for a 500 grand capacity. of which 200 is consumed on your own mortgage.
Okay, I see.
This
Okay.
this means that you still have 300, extra capacity to help your child.
Okay, so the whole 500 isn't being counted against me anymore. That's yeah, that's cool. That
Right.
I
Right.
didn't
They just
realize that.
Yep, they say you can manage 500, you've used 200, so you've got surplus with which to help. Yes.
Nice. Okay, so I have a question about that. So would it not make more sense for me to just qualify full, like if it's only 100 grand, let's say, fully qualify on that mortgage, keep my son's name off of the mortgage so that he could qualify for rental properties, perhaps, or something like that. We're talking to investors, so this might be a question
Okay.
that comes up. I know it has for me.
Yeah.
Should I even put him on there?
Yeah, look, I love that question. Right. So it comes down to if we're talking long-term mortgage qualifying strategy, then yes, the longer you can, or the less, let me put it a different way. If every property that you acquire is an income producing asset, then it means that it's not going to be a net negative drag on your next mortgage application if it's positive cash flow. So if you
Mm-hmm.
put your child into this property and it is 500 grand and his name is on title, then yes, in the future, when he wants to go and buy an investment property, the fact that he has this mortgage commitment, of say 2,500 bucks a month, yes, that's going to negatively impact his ability to qualify.
So if it's going to negatively impact my ability to qualify anyway, but I'm needed, he's kind of secondary. Then I guess that's all in the planning and structuring that you help
Yeah,
us
and
do.
I love these questions because these are the big questions because a decision today will impact what you can do 5 years from now. And this is where oftentimes we look beyond the current transaction and we say to you, okay, what are the goals for the next 5 to 10 years? And depending on your answer, then how I advise you to take name and structure on this property will change, depending.
Right.
Mhm.
Okay, so my other question about that, and this comes from my like working hard kind of mindset is if he can't afford to qualify for it on his own, should he be qualifying for it at all?
Yeah,
Am
that's a
I
great
enabling him
question.
to get himself into, you know, trouble,
Yeah,
hard
that's
times?
a great question. So a couple of points there. Back when you bought your property, say 10 years ago, the stress test did not exist. It means that if your contract rate on your mortgage was 3%, I just had to qualify you at 3%. Okay. Today, when we go to qualify for a mortgage, even though your rate may be 3%, we have to qualify you at 5.25, which is the qualifying rate. Okay.
Right.
So in many cases, the child can make the payment. They just can't, which is the real life payment, the monthly mortgage payment, but they can't meet the bank qualifying rate, which is about 30% higher than their actual rate, right? And so
Right.
many times people say, Dion, I can make that payment. That's not a problem, right?
Okay. Yeah.
And obviously they've done their budgets and we watch their budgets, and so that would be the case in many cases. But there are other
Yeah.
cases where it's not true, Tiffany, and we have to approach it differently there.
Okay. Yeah. Interesting. Okay. So helping our kids to buy a house may mean cash, but it could also mean co-signing or a combination, I guess.
Right.
It could also mean equity extraction. So I think this one's one that we all kind of understand that this is something we may do, but how do we do it smartest, I guess is the
Okay.
good question.
All right. Tiffany, what percentage of your listeners are property investors? Are the majority of them property investor owners?
All, yeah, well, all they're either
Okay.
investors themselves or planning to be.
Perfect. Okay. So I want you to imagine that you have one investment property and you've done everything right, and therefore it's positive cash flow. And let's just call it $500 positive cash flow. That's where that property sits today. Okay. You've owned it for some time, and so you've only got a 20-year amortization, 20 years left on that mortgage. If today we decided to take that mortgage and stretch it back out to a 30-year amortization, what will happen in many cases is that $500 positive cash flow will convert to 1,000 or $1,500 in positive cash flow. So by playing with the amortization, we've created cash flow. Let's be clear here, though. We are going backwards because we are pushing that amortization back another 10 years. But
Right.
if what we're trying to do is create a situation where it's not a drag on your lifestyle to help your child, then here's what's possible. At the same time, we push that amortization out, we grab an extra, call it 100 grand. Okay. And with that
Okay.
100 grand, that 100 grand could then be gifted to your child and then used as down payment. So if the cash flow was going to go from 500 to 1500, well, it hasn't gone all the way to 1500. It's now back down to 1000. But what's happened is you're in a potentially better or the same cash flow position as you were previously, and you've been able to help your child by extracting that 100K in this example.
Okay, so it's going to take us longer to pay off our mortgage. We're going to pay more interest on it in the long run, but in the short case, as to how our, lifestyle is affected and our everyday finances, that gets rid of that issue. Which, quite frankly, I mean, we're all real estate investors, so most of us will have other properties that can make up for that in time, right? So
Correct, correct.
it is, in my opinion, and I say this all the time, which is kind of, it's a little bit against the grain, although people are kind of agreeing now, that it's about the journey too. It's not about the destination. You have to love your life now, not just where you think you're going in real estate, and not just where you think real estate can take you, but enjoy the journey, or else you're going to leave the journey. And so by stressing ourselves out, those kinds of things where our cash flow is tighter, we're house rich, cash poor, that's the kind of stuff that takes us out of the game too soon. So
Yes.
by mitigating, pulling out your amortizations, and is 30 years, like, is that normal to get
Oh, yeah.
easily
Yep.
anywhere
Widely
in
available.
Canada?
Correct. Yes.
Okay, so I like it. Yeah. Then we're not, again, causing undue emotion in our own brains, but we're empowering, giving a step up to our kids. I
And
love it.
I always like to remind people, well, ask them, why did they start investing in the first place? Inevitably, people say, well, I want a better life for me and my family.
Right.
And so if that is the case, then this is a real need that your family has, and you have the ability to help. And I always say this, if you have a problem, but you have enough money to solve the problem, you don't have a problem. But sometimes we need to point this out to people. The problem that you're trying to solve can be solved. You just have to look at it through a different lens and remind yourself, why the hell did I, renovate this bloody basement and spend every weekend finding tenants? What was it all for? It was for something, and it might very well be this.
It might very well be this. I love that. We, in our Ignited program, our coaching program, we do, like, it's small group, and we'll do these portfolio reviews. And it's like, we're doing one tonight actually. But it's like, okay, you've got, this vision of what you need and what you want. You have all these properties or all these different things set up, and you might already be at your goal. You might just
Mm.
have to, like, switch a few things around, change the order of some things maybe, but you might already be there. And so, interestingly, when we think about our kids and we think, how can we help them buy a house in 20 years, or how we can buy a house in 10 years, it's like that's a long time problem that's just going to sit with us, but we might already be there. I like it.
Yeah, yeah. And I mean, many of you listening right now could be mortgage free tomorrow if you chose to sell some of your investment properties, pay off the others, pay off your principal residence, you'd be debt free tomorrow. But I wouldn't recommend it. I'd say hold on to growth assets as long as you possibly can. But again, there comes a time when all this hard work and I call it the planting of the seeds, that you planted these seeds in order to harvest them at some future point for a future need. And again, it's assessing, is this the time? Is this the time to chop down a tree? Could be. Mm.
Right. Or is it time to plant another one? Yeah. Yeah.
Yeah.
Love it. So I'm just going to read, Stephen I didn't read all of it, so I'm just going to read it to you. I co-signed for my son. He bought 2 rental properties. Nice job, Stephen. However, it prevented me from buying anymore as my debt ratios went up. Now he qualified on his own, got his own mortgage, and has since taken me off his titles. Nice work. But now he's further ahead as his places have gone up in value.
Perfect. Yep. And
Boom.
so, yeah, look, as parents, all we do is sacrifice. Along the way, it transforms into a couple of different things. And in Stephen's case, he sacrificed his ability to grow his portfolio for a couple of years. But the return on that is his child is probably now sitting on an extra couple of $100,000 that his peers are not sitting on, right?
Right.
And so
Yeah.
it's again, we from the day our child is born, we're sacrificing. It's just how are we doing it through time, lack of sleep, and or driving them all over the place, and now giving them money, maybe taking our foot off our own gas pedal as it relates to our own portfolio growth, but for the benefit of, the overall family unit.
Well, and I love what you said that what was it all for in the first place anyway? That's what it was
Yeah.
all for anyway. It's just maybe a different way of getting there. So yeah, awesome. Fritz says, I love this. Yay. Um, Fritz is such a hard working investor. And she's
Okay.
so smart. She's brilliant and she's got littles. So this
Uh-huh.
is, really timely for her for sure. All right. Any other questions, guys? Throw them in the chat. Um, Next point that you had that you like
Hmm.
to talk about and teach us about is family investment structures.
Right.
Tell me what you mean.
Okay. So I want you to imagine that your child is in their 20s or 30s. They've been renting, they're living maybe close to where they work because it's convenient, and they're just renting there. They're very happy. Now, the thing
Sounds
is,
like my kid. Yep.
there you go. Right. Now, back when you and I were a little younger, Tiffany, people were marrying in their 20s. I got married in my 20s. Most
What are
people
you
did.
saying?
I'm saying that you and I are from a different vintage. Um,
We perhaps are.
right. But now, if you were to look at the average age at which people are marrying, if they're marrying at all, it's quite a bit later and it's well into their 30s. Okay. And what I want to talk about here is what I call the lost decade of equity. Because let's just say people used to get married at 25 and now they're getting married at 35. Okay. When you got married at 25 and you had a double income, that was your opportunity to enter the real estate market at age 25. Okay.
Right.
That's not happening now. It's happening at maybe 35. Okay. And even then, a double income is struggling to qualify for the properties that we're talking about today. And in that
Interesting.
10-year window, for most of us, if we'd bought a property at age 25, by the time we reached age 35, that asset had probably increased by maybe 25% in value. Let's
Right.
call that 100 grand for round numbers. That 100
Sure.
grand is now missing. It's disappeared because of this change in societal structure and what's important and values and coupling up and all of that, right? And so understanding that and understanding that maybe one day in the future my child will get married, maybe we shouldn't waste this decade. Maybe we should help our child get their foot on the first rung of the property ladder, and it's not necessarily having to make them buy a place for them to live in. It could be the idea that, hey, you live there, you're happy, that's great. Let's go buy a property out there where we can buy a duplex, a 4-unit property that we can co-own together with you because you won't qualify by yourself, but we'll put your name on that. And then if and when in the future we want to access that equity through refinancing and or selling the property, we can split the profits between ourselves, and or you might choose to give the entire profits to them because they've been, very good custodians of the property, right? Then what you're doing is you're encouraging them to co-invest with you on your next project and share in that uplift over that period of time. And yeah, interestingly, this statistic, Tiffany, was published a while ago. 15% of property investors in Canada do not own their principal residence,
Ooh,
right?
I like it.
And so
Yeah.
that's the exact example of that,
You know what? I like it. So I'm in a stage of my life that I bought my first home at 19
right?
and have owned properties, then bought that was my primary bought, investment properties or whatever. So now I'm 40, almost 49 years old and and I'm in an Airbnb right now. I'm in a
Okay,
transitional situation in
right.
my life. So I'm in an Airbnb and I'm like, I kind of love just like I can go wherever the heck I want. I can float here or float there. I have a niece that's going to have a baby. I have a cousin. Like, it's kind of cool to just be floaty
Hmm.
and not have
Yep.
this commitment. So, yeah, it's interesting. Okay, so the part about you buying a property. So you're in the GTA.
Yep.
Tyson is in the Vancouver area. He's got, kids too. So would you buy something like completely like out in St. Catharines?
I would buy where the numbers make sense by
Okay.
your own definition, right?
Yeah.
Now,
Okay.
what's important to different people is different things, but I'm not adverse. I own properties internationally, so I'm not tied to the idea that I must visit my property and manage my property. In fact, if I did that, I would not be a property investor. I would go insane, right? And so where I buy, I'm agnostic. I don't care. As long as
Mhm.
the math makes sense, as long as all the economic fundamentals of future growth are there, and if cash flow is important, we need to watch that number too.
Okay, so it is definitely like you're buying a rental property, but in the back of your mind, or even perhaps on paper, it's being put aside as this is my investment in the down payment for this child. This is my investment in the down payment for this child. Like you're just planning that way, but these are just straight up rental properties that will always be rental properties, most probably.
Correct, correct. I mean, look,
Okay.
if your child ends up wanting to live in it, that's fine, but that's not the only intention for the property. It is simply to create equity to give you more choices. And I call this putting pieces on the chessboard, right? You're doing what you're doing in life right now, Tiffany, and paying Airbnb prices because you put all these pieces on the chessboard and you can play a different game than everybody else, right? You've got more pieces, you've got more choices. And so for anybody listening who has little kids or kids in their 20s, the thing is, if you can just get more assets and hold on to those assets for as long as humanly possible, trust me and Mr. Buffett when I say, the longer you can hold them, the more choices you will have for you and your family.
Yeah, for sure. Okay, I love this. I'm just thinking about one of my best friends when we were about 19. Her and her husband wanted to live downtown. And so they rented a condo downtown in a funky little area, but they went and bought when we were quite young a big house like at the time it was like an executive home. We were like, why are you? And they rented it out for probably 15 years.
Okay.
And then when they had kids and they moved out to the burbs, they
Hmm.
had this house that had a very small mortgage on it. And you know what? Maybe not 15 years, maybe 10 years. And so it's kind of the same idea.
Yeah.
You don't have to buy into that lifestyle to create that freedom. So yeah, I'm loving it. Okay. When you place all the pieces on the chessboard, yeah, totally
Hmm.
agree. Okay, so let me see. Oh yeah, you are the 15%, Adrienne. So Adrienne in Halifax, she
Yes.
is renting. She's got 4 kids. She had all 4 after the age of 40. Uh,
Wow. Okay.
right. She's a rock star. She's also an investor. And she actually rents a bigger house while
Hmm.
having rental properties. So he rents a
Okay.
house that's her family. So there you go. Exactly
Yeah.
what you're talking about.
Perfect.
Okay. So so is there a better um is there a tax advantage to any of these strategies over another one? Um yeah.
Well, yeah, I mean, look, if you're going to help your child acquire a property which could be their principal residence, then as we all know, the capital gains tax is not applicable if in the future they sell that property, right? So that's if you're looking at a pure tax play from a tax advantage perspective, that's one way to look at it.
Yep.
Well, and I mean, if you were to say co-invest, you have your child living downtown and the three of you buy a property out sort of in the outer areas, then all of the standard taxation benefits and challenges come there, which is, tax deductions with mortgage interest and property tax and insurance, etc. So I wouldn't say there's anything like extraordinary there. It's kind of like what's important, which is if cash flow is important, It might be go and buy that outer ring property that's purely investment. But if cash flow is not important, if your child isn't of the mind that they want to go and build a portfolio and they just want a place to live, then,
Yeah.
and as much as we want all of our exact values to be taken on by our children, we all know that that's never the case, right? Especially from a financial
Absolutely.
perspective. If all they want is their
Yeah.
own home, then it's just, okay, if that's the right play, and taxation is really sort of secondary.
Yeah, I do agree. Had to ask the question. But I do agree. Like if you're making money, you're gonna pay tax and whatever else, right? So it's just yeah, you do what's right. So I have two questions about the kids bit too.
Sure.
Um, you mentioned putting them on the mortgage. You mentioned having them yeah. So at what age can they come be on that mortgage, let's say, legally?
Yeah, I think technically the answer to that is 18 when they're of legal age. The youngest that I've done is 21. And I think
Okay,
that's for the most part when maybe parents feel like the kids have a little bit more of a head on their shoulders in terms of what they're doing. But
right.
yeah, I can tell you that the youngest I've done is 21.
Okay. Okay. Awesome. Now, how would you change, let's say this family investment structure that you we just talked about, how would you change it if you had a 10-year-old child versus having a 20-year-old child?
Okay. I'm going to give you a real life example again of me. So back when I had my first child, I think this whole protection of people's privacy didn't exist. And somehow we got a call from the RESP guy, the Education Savings Plan, right?
Yeah,
They
yeah.
must have
Hmm.
sold our names. This is a new family with a new baby. So this guy called me. And
Yep.
firstly, I was a little bit pissed off. But at the same time, I'm like, let's just see what this guy has to say, right? So we invited him over. And if any of you have children, you've heard this. So this is a reminder. You invest $200 a month, okay, for 20 years. The government will match you at 20% to a maximum of about 7 grand. At the end of this time, you would have outlaid about 48 grand with the government's extra bit in there. You got 55 grand invested, okay? And then all the schedules show that by the time your child's 20, you should be able to give them 100 grand for their education. So that's the math on a standard RESP. Okay. So I just want you
Okay.
to, I'm using that as a benchmark. All right.
Yep.
Now, when he left, I said, okay, that's great. Thank you for the information. And then I sat down and I did the math that I've been doing around real estate forever. And back then, properties were like 400K. And I did the math and I did it at a standard 5% appreciation over the same 20-year period of time. And that number was closer to $900,000. Okay. With a negative $200 a month cash flow because I was comparing apples to apples because it's instead of 200 there, I was 200 here. Okay.
Nice. Love it.
Right. And so when I looked at that, I said, well, we'll never do the RESP. We will instead buy real estate. And so I have two daughters. They each have a house on paper. And we know that when they're 20, they're now 11 and 13, but when they're 20, they will be given the keys to houses worth $1 million plus in equity. So how does that translate to the 10-year-old? It's the same story, right? The earlier you start, the greater the time you have to allow compound to do its thing. I know that we are currently in a weird stage in the property cycle with, interest rates where they are, property
We
prices
are.
down. And the one thing I will say to anybody is the one thing I can say for certain is you're not buying at the top anymore. And so if you can just find that cash flowing property that you're willing to just plant and let sit there for 10 plus years, I think for the most part, you're probably going to be fine.
Amazing. I love it. Okay, and I'm going to pick on a word you said, and it could be just how you said it, but you said on paper. Does that mean that they're on title? Your
No,
your
no,
daughters?
no, no, they're
Okay,
not on.
so
Yeah,
just in theory.
correct. Yes.
Okay, okay. Okay. Let me see. Any questions? Do all they're fooling around in the chats about all the different YYC, YYZ, HTX,
Ah,
GTA, all the different acronyms.
right.
Um, let me see. Uh, estate planning, leaving properties to children. Oh, I didn't see Tyson's question. Sorry, I'll go back to it. But okay, let's hit up estate planning and leaving properties to children. Um, do you work with estate planners specifically to plan that out?
Yeah, this is a tough question, and it depends on everybody's individual circumstance. You really do want to engage an estate planner at some point on the journey. The simplest version of estate planning that I've seen is, okay, if you're 50 and your child is 30, then you can simply add them to title to that asset. And so that if and when you pass, they are now the owner of that asset. They'll have to deal with a taxation event, right? But again, the extent of that is really dependent on their circumstance. The other way too that a lot of people are planned for transition of their portfolio to their children, understanding that capital gains tax will be triggered at time of death, is through life insurance policies. I'm sure, Tiffany, in many of your Tuesdays, you've probably had life insurance advisors come on. And in many cases, my clients say, look, I'm probably going to leave $7 million to my kids. It's going to result in $3 million tax burden. I'm going to take out a $3 million life insurance policy. And if they want to, they can sell the assets. But if they don't want to, they can use this 3 grand to pay the tax. So again,
Yes.
I'm not licensed in that area, but I'm just sharing some ideas that others have shared with me.
Yeah. No, I love it. It's awesome. Okay, so if your kids are young, would it be a good idea to put investment properties in a court so that when it's time for them to access the equity, it doesn't trigger capital gains?
Okay. All right. Again, I got to kind of stay in my lane here. I'm the mortgage guy, not the taxation guy. But that is certainly a question to ask a tax accountant and financial planner. But I will say that um, if you can add your child to the corporation and or to the title to the property before your passing, it generally makes for an easier transition.
Yeah, that's what I was just thinking is that they could even kind of buy in shares. Yeah, let's talk about that. So Tyson is in our Ignited group. So let's talk about that in laser as well. Flush that out just a little bit more. Okay. Any other questions, guys? We are wrapping her up. This is awesome information. Now to contact you, and this is what's fantastic too. So Dion obviously has a lot of knowledge. Dion, you know what else I wanted to read because um, this is crazy. Your reviews are ridiculous. Like
Oh,
you've
yeah.
got
Thanks.
crazy reviews. So over 500 five-star reviews on Google for a mortgage broker. I'm sorry, but that's really hard to do because,
Yeah.
mortgage brokering is not the easiest job.
Well,
Um,
getting financing is never fun. And
it's
so
never fun.
to get a client to reach the financing stage and say, okay, that was okay, or better than okay, that's always nice. Yeah.
Yeah. So just a couple of them that I screenshotted was his attentiveness has been nothing short of excellent. Um, we cannot sing his praises enough. Genuine personal service. Their virtual process was seamless, transparency and guidance. Um, yeah, like just there's so many of them. They broke things down simply. So, oh, more like a conversation than a transaction. Like fantastic stuff
Yeah.
here, by the way.
Yeah.
So
Thank you.
good job.
Thank you.
That's hard to do. Um, and I was going somewhere with that. I don't know where. Oh, I won't touch my nose. That's a bad. So if you, oh yeah, that's what I was gonna say. If we want to get a hold of you,
Yes.
you talk to us personally here in Fearless. Not everyone, you said, but
Correct. Yeah.
so if we're going to throw your contact information in the chat, what does that generally look like when someone contacts you?
Yeah, so you book into my calendar at a time of your choosing. We would send you a quick questionnaire. It's like it'll take you less than 5 minutes to understand where you're at. Because when we jump on the call, I don't want to be extracting information. I want to be giving you options and giving you guidance. So,
Mhm.
yeah, and that call will run from anywhere from 30 minutes to an hour, depending on your particular situation. We always lead with education and trying to figure out where you want to go, reverse engineer it, and sometimes we'll paint a path to get there. And sometimes that person will execute immediately, and sometimes it'll be 3 years before they actually execute. But the part of the job that I love the most is actually shining light on opportunities that people didn't realize were available to them. And in the world of finance, there's a lot that a little bit of information is good, but a lot of people come to me after dealing with their bank and maybe their bank advisor for many years, who was confined to a certain product offering. And when they come to us, they have no idea what else would have been possible. And if that the comment I hear a lot is, Dion, if I'd spoken to you 10 years ago, I'd be well and truly another $1 million richer, right? Because just a little bit of tweaking here or there will get you there faster.
Yeah. Yeah, for sure. Um, okay, so sorry, I do have a couple more questions for you.
Yeah,
I
sure.
forgot. Um, so what are some of the most common mistakes that you see um when when parents are trying to help their kids out? What are some of the common mistakes that you see?
Yeah, so it's the second order effects of that decision, which is, are you helping them with the right type of money? I'll give you a perfect example today. I had a client who um, was making around 10% in their TFSA managed through their financial advisor. And so they built it up to something quite significant. You'll probably know by now you can contribute 100 grand to your TFSA, but their balance was closer to 200 grand. It means that that was very well managed. Okay.
Yeah. Mhm.
And and they wanted to help their child. And they were going to take their money from the TFSA. Makes sense, right? Like, we've got the money, let's go use it.
Yeah.
But then I said, well, wait a second, you've got a 225,000 available line of credit on your home equity line of credit, and the interest rate there is 4.95%. And so, does it make sense to take away making 10% a year tax free, or does it make sense to borrow this 100 grand at 4.95% and continue to maintain that growth? Of course, the math is the math, but they just didn't realize that, that was an opportunity, a possibility for them. So little tips of guidance like that is what we love to help people with.
And that's the thing. Sometimes, like we all know this. We're intelligent people. We've worked hard to learn about this stuff, but sometimes when we're in it, we can't necessarily see it for ourselves. So yeah, having someone that can take a look at it for us is amazing. I love this. You open the doors to all these possibilities. Thanks for sharing your insights.
Yeah.
That's just a comment. And okay, so nope, hang on one sec. I lost it. Oh, okay. Can you add your kids to title
Yes, yes, you can.
before they're 18?
In my experience, no. They need to be of
Okay.
legal age, right?
Okay.
Yeah.
Um, if I add them to title, will the bank not want me to then add them to the debt?
In most cases, yes. Yeah.
Yes.
And so
Okay.
let's just say that you have a child, their intention is to purchase their own property at some point in the future. It may not be the best move for you to add them to an existing property if it means that in doing so, they must be on the mortgage and therefore on that debt as well,
Yeah.
right?
Yeah.
But I'll tell you that if we go sort of a couple of years ahead, um, if let's say you own an investment property and you want to add your child to that investment property, let's say they're done with all their property acquisitions, they're good, and by adding them to title, it's only of a benefit, especially for estate planning. Then we help
Yeah.
many people do that. Just understand though that we do have to show that when there's a change of title, you can't change title to a property without the bank being alerted. Okay. Meaning that if you've got a
Right.
mortgage with TD and you just add your son to title of your property, TD is going to be alerted. They're going to, who is this person? And they're going to want to know everything about their income and their credit history, just in the same way that you qualified for that mortgage. They want to make sure that this person is not bringing any negative burdens to the title of the property or the mortgage. So if your son was
Right.
previously bankrupt, they probably would not be allowed to be added to title because the bank wouldn't want that person attached to that mortgage.
to that mortgage, right? So it's somebody who has a piece of the pie without having a piece of the debt necessarily.
Right. Yeah.
They're not going to want that. Yeah. Okay. Girls, if you don't mind, ladies, I shouldn't say girls. I still feel like I'm 25. I'm not. But if you wouldn't mind dropping Dion's contact information and the link to his calendar into the slot. I love that you said some people are going to act on things right now and some people are going to act later. You understand that. You're cool with that. That's
Oh
great.
yeah. Yeah.
Yeah, fantastic. And yes, George, he does serve the Maritimes as well. So do you like Nova Scotia, New Brunswick, PEI, like you can write in all those provinces? Yes.
Correct. Yes. Yes, that's right.
Perfect. That's fantastic. Seriously, that's really good. So, okay. His contact information is in
Yeah.
the chat, guys. Kanga Mortgages. I'm hoping we're going to see more of you, Dion. I just love how your brain works. I'd love to keep on picking that brain of yours. But thank you for joining us. Really appreciate it. Love all the information. Love the different view that you're bringing to make us think differently about how we help our kids. It's important.
Great. Thank you. Thanks for the opportunity. And for those of you that I'm lucky enough to chat with, I look forward to those conversations.
Right on. Thanks so much. And guys, next week we will see you back for another Tactical Tuesday. We are winding down Tactical Tuesday, so we only have a few left for the year. So yeah, join us next week. We'll see you at 7 p.m. Eastern. As always, also, we have an open house. Almost forgot an open house. If you're wondering about getting some coaching and you want some help, we did do one back in 2021, I think, an open house for the Ignited mentorship program. So jump in and join us on Thursday night if you want. The girls will also put that link in the chat if you want to find out what Ignite is all about. Why are the Ignited members the most successful of all the groups that you know and see? Why is that? And why are they standing the longest? Not just getting into the market, getting in is easy, but why are they still standing in the market after years? That's the most important part. So yeah, you're welcome. Everyone's saying thank you. So cheers, guys. We'll see you next week and have a beautiful week. And Igniteds, we'll see you over in Laser in just a few minutes. Cheers.